this section, we will identify some of the key strengths and weaknesses of quantitative strategies. Markets are often driven as much by emotions as by fundamentals. While it is sometimes important to factor in market sentiment, it is usually not a good idea to let your own emotions color your trading decisions. In my experience, traders' sentiments swing wildly between greed and fear, blinding them to what is really going on in the market. Greed and its enabler, egomania, often cause a trader to refuse to take profits and ride huge winners all the way down to huge losses. Fear and its enabler, self-doubt, often cause traders to liquidate positions due to short-term losses that would have eventually turned into big winners. Once a strategy is agreed and the rules are in place to control changes to that strategy, it is more likely that the careful reasoning used to construct the strategy will prevail over the short-term desires to tweak or modify it. This makes risk management clearer and also keeps the emotion out. Correctly formulated strategies are always optimal from a mathematical perspective. This optimality may prove illusory, but it still represents the collective wisdom of a strategy's developers and is a big improvement over the strategies based on sentiment. Quant trading, despite being rules-based, emotion-free, mathematically optimal, is still quite risky. Small firms blow up all the time, and even some of the biggest firms like Knight Capital have flamed out in less than an hour of trading. Knight was the largest trader in U.S. equities with a market share of around 17% on both the New York Stock Exchange and the NASDAQ. Knight's electronic trading group managed an average daily volume of 3.3 billion trades, trading over 21 billion daily. And yet, due to a computer glitch, Knight accidentally bought $7 billion of equities in 45 minutes with no customer orders or funds to pay for them. It tried to cancel the orders but failed and was forced to sell the stocks at a $478 million loss. With this loss of trading capital, it had to accept a capital infusion from a rival firm who eventually ended up taking it over. Quant trading already dominates the market and is extremely competitive. That said, it is the only area of trading that is growing, and anyone who wants to develop or trade strategies should invest some of their time and effort on their coding and statistical skills. Quant strategies are only optimal within the context of their assumptions made during their construction. This is a weakness, but it is also true of any strategy that attempts to predict a random variable, such as equity prices. Profits are never certain in a risky strategy. If you want a guaranteed return, you should be a buy and hold investor in government bonds, most of which yield a negative real return. Lastly, markets are always changing. Uptrending markets and assets suddenly reverse to downtrend, which can cause correlations to reverse and volatility to spike upward. Overall, though, the rapid expansion of quantitative trading shows that the opportunities outweigh the challenges. I hope as we work our way through this course, you will gain a functional understanding of the real-world applications of quantitative trading techniques, and also how machine learning and AI can help you leverage your development efforts and make your strategies more effective and profitable.